Look at a busy market. Money is constantly changing hands, but making a sale does not automatically mean a business is actually making money. Survival requires knowing the math behind every transaction. The most basic law of commerce comes down to two numbers. The cost price is what you spend to acquire an item, and the selling price is what your customer pays you for it. This chart shows the ideal scenario. You buy an item for 50,000 shillings, and you sell it for 60,000. When your selling price is greater than your cost price, that 10,000 shilling gap is your profit. If the reverse happens, you take a loss. Relying on this simple subtraction is dangerous. In the real world, businesses often collapse because owners fail to track the hidden variables that eat away at that gap. Between the moment you buy an item and the moment you sell it, costs accumulate. You might pay for a boda, import taxes, or minor repairs. This diagram maps out how those expenses behave. If you buy inventory for 800,000 shillings and pay 20,000 for transport, you must add those together. Your true cost price is 820,000 shillings. If you sell that inventory for 810,000 shillings, ignoring the transport cost makes it look like a 10,000 shilling profit. But when compared to the true cost price of 820,000, you are actually taking a 10,000 shilling loss. Calculating the true cost price allows a business owner to see exactly where money is leaving the operation. It turns a guessed price into an informed decision that protects the business's cash flow. To measure how efficiently a business is running over time, owners convert these raw numbers into percentages. A percentage profit tells you exactly how hard your money is working, regardless of whether you are selling single items or bulk orders. This brings us to the most common mathematical trap in commerce. Many people calculate their percentage profit by dividing their raw profit by the final selling price. That calculation is mathematically invalid. Profit and loss must always be measured against the original money you invested. The denominator in your formula must be the cost price. Measuring your returns against the selling price creates a completely distorted view of your business growth. Your initial investment is the only accurate anchor. When you want to scale that growth, you often need to borrow capital. Banks charge a strict rental fee for using their money, known as simple interest. This formula calculates that fee. Simple interest equals the principal, the original amount borrowed, multiplied by the interest rate, multiplied by time, all divided by 100. Let's test this. Calculate the simple interest on a 200,000 shilling loan at a 5% rate for exactly 6 months. Pause the video and try it yourself. If you multiplied by 6, you fell into a common trap. In financial formulas, time must always be measured in years. 6 months must be entered as the fraction 6/12, or the decimal 0.5. The result is 5,000 shillings. The final debt consists of both the original capital and the cost of renting it. Without this math, a business owner cannot know if their expected growth will actually cover the cost of the loan. Let's combine these rules. Imagine a media consultant imports a professional video camera. The base cost is 2.5 million shillings, but he also pays $150,000 in shipping and $350,000 in import taxes. A year later, he sells it for 2.4 million shillings. This chart visualizes our first step, finding the true cost price. We sum the 2.5 million base cost, the $150,000 shipping fee, and the $350,000 tax. This sets our true cost price at exactly 3 million shillings. Next, we compare that total against our final selling price of 2.4 million shillings. The selling price is strictly lower than the true cost price. Subtracting the two reveals a raw financial loss of 600,000 shillings. To find the percentage loss, we divide that 600,000 shillings by our initial investment, the 3 million shilling true cost price, and multiply by 100. This calculates out to a 20% loss on the investment. Survival in commerce relies on accuracy. Always track your hidden expenses to find the true cost price. Use that figure as your denominator when calculating efficiency, and always measure loan time in years.